expensive one to try and get acquisitions done in. And so, again, those sort of three precedents leaning into returning capital to shareholders, I think Amazon's got the same rationale to do it, and I've been waiting for a dividend for a while. Over $70 billion of cash on Amazon's balance sheet and counting. It's trending upwards.
I mean, you said that, I love, you've got so many exclamation marks. I didn't know what to do with the caption, which was, here's looking at you, Amazon, exclamation mark, by 25 exclamation marks. I think you were just enthusiastic. It's your favorite one, and you're adding to it. I mean, what is the ultimate driver of why you would add to Amazon relative to Microsoft and relative to Google on the cloud narrative?
Well, on the cloud specifically and the growth of AWS, we're continuing to see corporate capex in moving towards using the cloud a lot more aggressively, and especially when it comes to thinking about cybersecurity considerations and the intensity of more use of data analytics. So AWS's growth, it isn't the juggernaut it's been in prior years, but it's steady. It's a fantastic cash flow machine. It's very, very high margin. It's extremely sticky. So if you look at that profile, not just to be the piggy bank, the ATM that's going to fund dividends and getting capital back to shareholders, it's also, a fantastic piggy bank, a war chest to go and allow Amazon to continue to invest in things like more live sports on the video side, continue to invest in developing its private label offering on the retail side. I just think it's a fantastic portfolio of not going anywhere services and products.
I look at what you write about Meta and Netflix, and if we look at the price reaction on those days when they delivered their earnings, the numbers in terms of subscribers was great for Netflix, but it was about the projection forward. And likewise with Meta, it was about the projection forward. So to what extent do those kind of cathartic moments in big tech provide people like you to actually pull the trigger and deploy more cash there? Or are you more hesitant when you see this kind of pillorying of stocks?
I would put them in slightly different buckets. Let's start with Netflix. Had some very good news in Netflix, but what I didn't like about it is the fact that the company announced it would cease to report on its subscriber numbers. And so when you see a business like Netflix taking a core metric, shifting in this case towards talking more about engagement, but creating opacity around the core driver of growth, that I don't like, and I think that was a big part of the reaction, on top of the fact that the earnings outlook was at the lower end of estimate.
Does that just lower your trust in the stock?
It lowers the ability to put together projections, and at the end of the day, these are all DCF businesses, they're growth stocks. It makes it very difficult if you're an analyst on Wall Street to have a model that you've got super high conviction in to make calls. So I think it's not so much about trust, it's about the ability to be credible in making your recommendations, and I think that's problematic. I put Meta in a slightly different bucket, which is Meta actually had a pretty good backward-looking earnings result. The problem there with Meta is it's seeking to double down, and this is another credibility issue, double down in investment in AI when Meta has proven it has not been a great allocator of capital when it comes to new technologies, and specifically talking about its investment in the metaverse, where we've seen $40 billion evaporate and we're not sure what's going to come out of it. The idea that Meta is going to be the trusted steward of capital to deploy against AI without a very clear strategy is problematic, and I think we're seeing those with clear strategies versus don't, and those with clear earnings outlooks versus those who don't, really separating in the pile here.
Now, and you're criticizing the Genius for spending $40 billion on the metaverse. That's a reasonable criticism. What does he need to do? What does he need to do to reinstate Genius leadership within that space, that you would trust him again as a guardian of capital in the AI space? What is it that redefines that narrative?
There's a couple of things with respect to the business model, and we can start with AI. Generative AI is something that is a buzzword. It's all over the street. Very, very few companies have come out and said, this is how we're going to deploy it in our products. This is how we're going to charge for it and monetize it, and this is going to be the impact on the bottom line. We need to see that specificity and clarity coming out of Mark Zuckerberg and his team over at Meta. We also, I think, need to see the following. If we talk about augmented and virtual reality, and Facebook's position in Quest, it is still the leading headset provider. And we know that Vision Pro for Apple has not been taking off and not been adopted with the rapacity that we had hoped. And that's an opportunity there for Meta to lean in and say, look, finally, we're going to prove that some of that capital is decently spent, still not great ROI, because we're going to remain the leader in that space where Apple is stumbling at the moment. I think those are the two things that we need to see and hear pretty quickly.
And we didn't get to the show and tell that you want from PayPal, but the stock is up 4.5%. We'll get round to that when we catch up again. That's Anne Berry, Threadneedle partner and founder, my guest this morning on All Things Tech. Coming up in the show, it breached 160 and the Bank of Japan had enough. Data suggests they did intervene. We will discuss next on Bloomberg. Japan likely conducted its first currency intervention since 2022. The hope was to prop up the yen. According to Bloomberg analysts, the central bank accounts spent in the region of $48 billion to do so. Enda Curran is with me. Well, if they spent $48 billion, Enda Curran, good morning to you. Dollar yen's trading at 157.46. I wouldn't put it down as a resplendent success, but call me a cynic.
No, it's going to be expensive, Manus, and there's no doubt that the backstory to why the yen is so weak is because the dollar is so strong and US rates are very high, and that isn't going to change dramatically, at least, anytime soon. Now, the Japanese authorities have yet to confirm officially that they did intervene to buy their own currency. Our own colleagues in Tokyo ran the numbers on the published Japanese Bank of Japan accounts, and they've calculated that there's about 5.5 trillion there unaccounted for, which probably speaks to the idea that they were intervening to prop up the yen in the market. Now, as I say, the authorities haven't confirmed this. It did drive at least a short-term rebound from that 1990 low that it hit. But as you say, the broader backstory of dollar strength and high US rates, that hasn't gone away, and that's probably going to keep pressure on the yen in the near term at least.
It is, and we're counting down to the FOMC, and there's a number of narratives out there, aren't there, Enda, that, well, if they did intervene, why would you intervene ahead of the FOMC? But take this a little bit further, because the other narrative from John Arthur's column is that Ueda's narrative and guidance on inflation was moderately dovish on Friday, and yet we volte-face 48 hours later, and if they confirm that they intervened, it kind of undermines the narrative of Ueda.
It's tricky for them because, practically speaking, by the way, or tactically speaking, there's a view that if they did intervene, they chose Monday because it was a holiday, so thin liquidity, more bang for their buck. But as you say, we've got the Fed coming tomorrow. Broadly speaking, analysts are expecting, something of maybe a hawkish message from the Fed. That's obviously going to impact Japan's currency. The authorities there say it's not about the level, it's about the pace of the decline. It's about gappy moves. That's what forces them to intervene. They're not standing back and targeting any particular level. They have to respond on the day that's in it. And of course, the cheap currency, yes, on paper it might help exports, but there are variables in that story as well. But it also means Japan is importing a lot of inflation through its energy and through its food. And tradable inflation is a big part of the Japanese inflation story at the moment. So it's a complicated balancing act for the authorities, but the line they keep pushing is it's when it's gappy and when the price action is too volatile, that's when they look to step in. They're not necessarily targeting a level per se.
And if we just broaden this conversation, Enda, we have a strong, a unique position for the dollar. It's already been identified by the IMF as being problematic. Yellen has got this cohort, this trifecta cohort between South Korea, Japan and herself, i.e. the United States of America, tacitly accepting that they may need to intervene. But from a broader FX perspective, for other emerging market central banks, Enda, this strength of this dollar is becoming almost to a breaking point for them.
Well, it's definitely a complication, no doubt about it. If you're in an emerging economy and you want to bring down your own local interest rates to support growth, it's complicated because dollar strength means your own local currency is weak. That means you're importing inflation, and of course it's creating other problems too in terms of your capital flow. So it's definitely slowing down the process for emerging economies and some advanced economies to bring down interest rates. Now, broadly speaking, the emerging markets have held up pretty well over the past few years, despite everything that's been thrown at them with COVID and with the inflation shock and the high interest rates that have come. One of the messages from the IMF recently was that EM has held up better than expected. But the longer US rates stay high, the longer the dollar stays strong, then of course, yes, that pain will continue to flow over to emerging markets. It was a talking point here at the IMF meetings a few weeks ago, and it certainly does remain a major complication for central banks in that part of the world.
Yeah, well, you just look at year to date and all of G10. There's nobody can challenge the dollar. Even old sterling's down 1.6% against the dollar. Time to change those dollars, Enda. Thank you very much, Enda Curran, on the potential. We wait for confirmation on the Bank of Japan, whether they did intervene or not, but the data looks as if it's flexible. Abigail Doolittle is with me as ever to define the sectors and the movement.
Well, it's pretty bearish right now, Manus, even though the overall decline for the S&P 500 itself is down about 0.2%. So not a big decline, but most sectors, 9 of the 11 S&P 500 sectors are lower, led by materials materials, energy, real estate, consumer discretionary, utilities. Those sectors all down more than 0.5%, but less than 1%. So not huge moves to the downside. Healthcare, on the other hand, being boosted by Eli Lilly on a good quarter on those weight loss drugs, up about 0.5%. You also have communication services just slightly higher. Relative to the month, we're looking at the worst month of the year. The S&P 500 heading down about nearly 3%. That puts it on pace for the worst year of month since September of last year. The two best sectors, energy and utilities. The two worst sectors, healthcare and real estate. It's interesting that utilities and real estate are splitting, Manus, only because they trade largely on dividends and rates. So the one is trading higher despite higher rates, and the other is trading the way real estate trading the way you would expect, with rates going higher, pushing some of those stocks lower.
There you go. 7.5% is quite a bruising. Abby, thank you very much. Abigail Doolittle on the sectors. Coming up, we'll set your clock for the events you need to know right here with your Trading Diary. Tesla had a banger of a day yesterday, up 15%. It is the drag today on the tech sector, down 3%. More job cuts may well come through. There is one saving grace in the underbelly here, and it's Eli Lilly, up over 8-9%. It is all about their obesity drugs. It's flying off the shelves. Stocks can't maintain. Right now, we're dealing with a spike in yields on the back of a higher cost index, employment cost index, and that irks the markets as we count down to Amazon's numbers. That's what's on the slate after the closing bell. Then you get the JOLTS data tomorrow at 10 a.m. Plus the Fed chair. He will speak after the Fed's decision. Apple's earnings after the closing bell. How bad was it in China? We will get the authoritative message. And that rounds out the week on Friday with the jobs report. Given the hot print that you've had in the ECI, we're going to keep a scrutiny across the wages data. That was countdown to the open right here on Bloomberg from New York. A very good morning.
All right, we are 30 minutes into the U.S. trading day on this Tuesday, April 30th. Here are the top stories we're following. All eyes on Amazon after show-stopping earnings from Microsoft and Alphabet last week. We'll preview today's action in the state of tech spending. And Eli Lilly's GLP-1 boom sends shares flying after the drug maker lifted 2024 guidance on the heels of soaring demand for its weight loss drugs. That really raises the stakes for rival Novo Nordisk, which reports later this week. And in conversation with Ken Rogoff, the Harvard University professor and chair of international economics, he joins in our Wall Street Week daily segment ahead of tomorrow's Federal Reserve meeting. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. And it really feels like the week is just getting started, of course, with Amazon after the bell tonight and, of course, the Fed tomorrow. You take a look at how markets are feeling heading into those events, and not too great at the moment. The S&P 500 currently off by about 0.2%. It's the same thing, too, if you take a look at the NASDAQ 100 off about 0.2% when it comes to your big tech names. Then you look at the bond market, and we are back in sell-off mode. You have 10-year Treasury yields currently higher by about 5 basis points. We are getting closer to 4.7% on your 10-year Treasury yield. And a lot of the reason why has to do with numbers that we got at 8:30 a.m. Of course, the employment cost index. Let's go to Bloomberg's Mike McKee right now. I can't imagine that ECI print was good news for the Fed.
Definitely not good news for the Fed, and neither is the consumer confidence numbers just out from the Conference Board. A big drop in consumer confidence from a revised 103.1 all the way down to 97 for the headline number. The present situation is also a big drop from 146.8 to 142.9, and a drop in expectations to 66.4 from 74.0. And of course, we have to check out the plentiful jobs hard to get situation, because that's a good measure of what we might get on Friday. More jobs ahead in 6 months, 11.7%, fewer jobs, 19.6%, and employment jobs plentiful, 40.2, jobs hard to get, 14.9. That's a move up in jobs hard to get. So people are beginning to feel a little bit worse about the economy, not in recession territory yet, but combine it with the big drop in the ECI, or the big rise in the ECI today, and the Fed has some issues.
Yeah, I mean, it's interesting taking the consumer confidence falling at the same time you have wages, or at least ECI, a measure of that, rising as well. I mean, wrap it all together in terms of what tone we might hear Jerome Powell take tomorrow.
Well, Jerome Powell is probably going to try to say as little as possible, certainly going to have to admit they don't have confidence now in an ongoing fall in inflation enough to cut interest rates. He will be pushed on the idea of, do you think you need to raise interest rates? And given the consumer confidence numbers and some of the other numbers we've seen showing a slowdown, he'll probably say, no, we don't need to do that, but we do have to keep an eye on inflation, and we aren't going to make any decisions right now, but stay with us.
All right, stay with us. Bloomberg's Mike McKee. I know you have a busy week ahead of you. Really appreciate your time right now. And let's bring this conversation to the markets, because joining us now we have Evelyn Mitchell-Wolfe. She is eMarketer Senior Analyst of Digital Advertising and Media. I won't ask you about the Fed, but I will ask you about Amazon, of course. We heard from some of its peers last week. I mean, you had Microsoft and Alphabet really with some blockbuster earnings. Not the same for Meta, which I'm sure we'll get to, but you take a look at Amazon. Feels like the stakes are pretty high when you consider, of course, the stock's performance so far this year. What's your expectations?
Well, at eMarketer, we forecast growth rates north of 20% for Amazon this year. Very impressive for a business of its size, and we don't expect this quarter to deviate too far from that annual growth rate. Of course, Amazon's retail media business is the center of gravity in the retail media space. Its growth rates are only second to Walmart in that space, but Walmart is actually less than a tenth of the size of Amazon's ad business. So different comparison there. And Amazon has a lot of draws for advertisers. Chief among them, its first-party consumer data, of which it has a lot. Closed-loop attribution is also a big deal for advertisers, more easily being able to connect an ad exposure to a sale or a purchase. So all of that plays in Amazon's favor, at least as far as advertising is concerned. And then, of course, we have to talk about AI as well and Amazon's cloud business. Those two things are kind of feeding each other. Amazon's investments in AI are helping to bolster its cloud business. And then as Amazon brings in more customers in the AI realm, there again, it feeds back into its cloud business.
So two things to discuss there, of course, the ad business and also AI. So let's start with the ad business. I know at a certain point, of course, those two intersect. But when it comes to the ad business, I mean, you think about what we heard from Google, you think about what we heard from Meta. How do your expectations for Amazon stack up against what we heard last week?
Well, we expect Amazon to perform in a similar way to Google and to Microsoft. This has been a pretty great quarter for tech overall, as you mentioned, and a lot of the same factors that are at play for Google and for Alphabet's performance, and then for Microsoft and for Meta as well, which we will get to, are at play for Amazon as well. Like we mentioned, AI is a big growth driver here, and also the advertising market is kind of in the middle of a rebound. It is not extreme, nothing like we saw in 2021 coming back from the kind of pandemic slump. But after the past couple of years of protracted economic uncertainty, at least Q1 was pretty solid. Advertisers started to open up their purse strings again. So we do expect Amazon to kind of continue the trend we've seen for the past week or so.
Well, we keep teasing it, so let's just get to Meta, because it was really amazing to watch the reaction after the blistering rally that Meta has staged, that big drawdown that we saw. It seems like shareholders really did not like, of course, the spending and also, of course, the revenue guidance coming in weaker. How did you take that, though? When you think about how markets reacted, was that an overreaction?
Well, I don't want to dismiss investors' concerns for sure, but Meta did have quite a fantastic quarter, all things considered. Some of those AI investments that investors are concerned about might take some time to meaningfully contribute to revenue, but Meta is well positioned to keep its ad business humming in the meantime, in part owing to AI-powered tools and solutions like Advantage Plus Shopping. And another thing that Meta has kind of changed over the past couple of weeks, it really thrust itself into this space when we talk about what's going on with Microsoft and with Alphabet. AI-powered search is another big theme here, and Meta hadn't been playing too heavily in that space until recently when it incorporated its Meta AI tool into the search function across its family of apps, Instagram, Facebook, WhatsApp. Fewer than half of US Facebook users would need to use Meta AI at least once per month for it to be as large as the market leader ChatGPT per eMarketer estimates. So that's a really big news for Meta, and I think it could be interesting to watch in the next few quarters as the Meta's competitors kind of catch up and react.
When it comes to the AI spend for Meta, clearly some skepticism among markets and traders, as you can see in the share price. But when it comes to some of the other big tech names that we're talking about, I mean, has AI actually translated to the bottom line? Is that starting to bear fruit rather than just being sort of a margin eater?
It seems so. I think we're in the very early days. I mean, we're still in the early days of the AI boom. But as far as impact on revenue, it will take some time, just as for Meta, for everyone, it will take some time for AI to really meaningfully contribute to the bottom line. Something that came out of Alphabet earnings that was really interesting was the executive's comments that compute costs have been reduced significantly. That is an important thing to keep an eye on as costs kind of normalize here. But AI is going to take some time. You know, we have a lot of tech infrastructure that has to adapt, social infrastructures that have to adapt to this new technology. It's not something that can happen over the course of a few quarters. We're already over a year into this kind of AI gold rush, and as the market matures more, it will just take time for people and for technology to adapt.
And that's exactly why we heard, of course, Mark Zuckerberg asking for patience. Maybe he's going to start to get that. But let's talk a little bit more about advertising, because I want to get your thoughts on what a potential TikTok ban could mean, not only for the likes, of course, Meta with their Reels products, but maybe some of these other businesses with big ad businesses. I know that it's very early days and there's a lot of questions here, but when you think about the potential impacts, what are your early thoughts there?
Yes, yeah. If a ban were to materialize, which obviously is still up in the air, YouTube would likely be one of the main beneficiaries of any ad dollars that advertisers had earmarked for TikTok. Instagram Reels as well would come into play. And although a lot of the same content that exists on TikTok exists on Shorts and Reels, one of the biggest factors that is missing on Reels and Shorts is the kind of cultural cachet that TikTok has. That's not something you can necessarily replicate with the same content or similar tech. And then there's also the question, of course, of TikTok's algorithm not being a part of any sale. Of course, if it goes away entirely, that's another thing. But we do expect a lot of those ad dollars to redistribute to other players in the short video space, not quite all of the TikTok dollars. That said, there's still questions about where consumers will go to spend their time. When India banned TikTok, a lot of that activity shifted to Instagram. We might see the same thing happen here. We might not. So there's a lot to kind of pay attention to if a ban materializes, which it may not.
Well, we'll have to keep in touch on that point, of course, as that story develops. Good place to leave it here, though, ahead of Amazon earnings after the bell. Our big thanks, of course, to Evelyn Mitchell-Wolfe of eMarketer. And let's take a look now at what's moving underneath the markets. We're going to do that with Bloomberg's Emily Griffeo sitting to my left. And let's start with Eli Lilly, because we're seeing a big pop higher in the shares.
Yeah, we're seeing that stock higher, biggest gain since August, up about 7%. And it was really all based off of an earnings beat that came from soaring demand for Eli Lilly's weight loss drugs. The revenue rose 26% year over year. And when you look at the two drugs, Zepbound is one of them. Their revenue came in at $517.4 million. That beat estimates of about $378 million. Mounjaro is another one of the drugs. The revenue actually missed estimates, but still fairly strong at $1.8 billion. This all resulted in the company raising their annual guidance for sales and profit. That stock, Katie, is up 99% in the last 12 months.
There you go. Eli Lilly just really knocking it out of the park. It'll be really fun to watch Novo Nordisk earnings a little bit later this week. But let's go from weight loss drugs to fast food, because Yum China not having a great day.
Yeah, not as good. This is the operator of chain restaurants, including Pizza Hut, KFC, and Taco Bell in China. And that stock is down about 6%. It was a first quarter revenue miss at $296 billion versus estimates of $3 billion. And when you look at the comps for KFC and Pizza Hut, those were misses as well. Bloomberg Intelligence, though, said that Yum China's second quarter sales might keep suffering due to a high base last year and ongoing budgeting by consumers. So there's a bit of a macro story here that we can learn about consumers in China maybe pulling back on ordering fast food, even though it is cheaper than maybe other food alternatives.
Even still, you look at the shares currently down about 8% on the day. Let's bring it home with PayPal, because we are really in the thick of earnings season right now.
Yeah, there's so many reports each day. This one was a pretty solid beat for the payment company. Total payment volume beat at $403 billion. That's up 14% year over year, beating estimates. Net revenue also beat. Interesting story out of PayPal is that they're seeking to curb expenses and right-size the business. The CEO said 2024 is a transition year for PayPal. He's a new CEO that they brought in about last year. The company also last year announced plans to cut about 9% of their workforce to really boost profits. So transition year for PayPal. That stock is up about 10% year to date.
Yeah, it feels like we've heard a few companies come out and call this a transition year. Definitely
an easy fix.
Easy fix. It's definitely a sign of the times. Bloomberg's Emily Raffeo, thank you so much. And we do want to bring you some breaking news now, just crossing the terminal, and that is that LVMH said to weigh options for Marc Jacobs amid buyer interest there. So we're going to continue to follow that story. But once again, some breaking news crossing the terminal, and that is LVMH said to weigh options for its Marc Jacobs brand, apparently receiving buyer interest there. A developing story that we'll stay on top of. But coming up, McDonald's reporting a rare earnings miss. We're going to explore what's behind sagging burger sales next. This is Bloomberg. Well, consumers are thinking twice before grabbing a burger and fries. McDonald's reporting disappointing first quarter results thanks to slowing U.S. growth and the impact of the war in the Middle East. Starbucks also reports earnings after the bell today, and the coffee chain, it's also vulnerable to slower U.S. demand and boycotts related to the war. And here with a preview is Peter Saleh. He is BTIG Managing Director. He has a neutral rating on McDonald's and a buy rating on Starbucks with a $115 price target. Great to have you with us. Let's start with McDonald's. You take a look at some of the results here. Comp sales coming in, the growth there coming in slower than expected, 1.9%. How much of what we learned this morning is a McDonald's specific problem versus just a macroeconomic problem?
Yeah, so great. Thanks for having me on, and really good question. So, look, McDonald's is seeing clearly a slowdown across several of its markets, the U.S. included, in many international, the large international markets. They're also seeing a slowdown among that lower income consumer, and really all income cohorts are visiting less often. What's really interesting here is that McDonald's is calling this out, but we're not seeing it at Domino's. Domino's said the exact opposite yesterday. And Chipotle last week said the exact opposite. They're seeing growth across all income cohorts. So this does seem like maybe a little bit more QSR specific, or maybe a little bit more to McDonald's than it is necessarily across the entire industry. But they are definitely seeing a slowdown. It's pretty evident in the numbers that they posted this morning.
So interesting perspective there when it comes to the competitive landscape to some of their peers who aren't having as tough of a time, which raises the question, I mean, what does McDonald's do here? You take a look, and it seems like they're maybe focusing on potentially a nationwide value menu, hinting at that in a call with investors. Would that be enough? What would the actual impact be?
So I think that is in the playbook, right? To push harder and harder on value. The value proposition or the value messaging really started in the fall last year, call it like October, and it intensified as we went through the year, and it has continued into 2024, and really even more intense in 2024 than it was late in 2023. We think it's going to continue for the balance of this year as they battle to get traffic back. But this value messaging, it takes several quarters to really start to work. So we're probably 2 quarters in. I think we get at least another quarter before we start to see any sort of response from the consumer, or maybe until we lap it come, the fall. I don't think we're going to see any sort of rebound. In fact, McDonald's is calling for U.S. industry traffic and QSR to be negative. It was negative in the first quarter, and they expect it to be negative for the full year. So they're going to push hard on value messaging. I don't know that it's going to really turn the tide anytime soon.
So there is a light at the end of the tunnel, but we're not exactly there yet, maybe getting closer. But we know that McDonald's also has tried to push out into other parts of the day, into areas such as breakfast as well. I mean, when you're visiting stores and when you're talking to executives, how much of a sense do you have of that actually being meaningful?
Yeah, so what we heard from our franchisee checks was that breakfast, weekday breakfast and weekday lunch were soft. Those tend to skew more lower income consumers. We also heard that the value mix has doubled versus this time last year, so it's about 10% versus 5%. So value is becoming much more aggressive. They'll continue to push on that. They'll continue to find ways on value. But what's really interesting also is that their loyalty program is exploding in growth, and loyalty customers visit 3 times more often than traditional guests. So the more they add more to that loyalty, the more rewards customers, the better off they'll be. But again, I think it's still insignificant in terms of the overall traffic component, and it will take several more quarters, maybe even a year, to start to see this traffic turn and go the other way.
So before I let you go, I do want to look ahead to Starbucks, which of course reports after the bell today. And you take a look at what the consensus says, maybe lower U.S. store traffic at Starbucks as well. That's the consensus. What's your view?
Yeah, so you're right. So the expectations for Starbucks are extraordinarily low. Stock's been under a lot of pressure as of late. We're slightly ahead on same-store sales versus consensus for this quarter. Again, expectations are really low, but I will point out that if you look at valuation, it's trading within 1 turn of its 10-year trough on EV to EBITDA, and within 2.5 turns of its historical trough on PE. So I think it's fully reflected in the stock price. It's trading like it's a broken story. I think right now, yes, same-store sales are under a little bit more pressure than they have been historically. They've had to take down guidance in the U.S. China has yet to recover, but to me, it feels like it's very much reflected in the stock price. If we get any sort of indication of a turn in trend here, even minor, I think the stock has a lot more upside than what is being reflected today.
Yeah, Starbucks shares currently down about 8.3% year to date. Watch for some fireworks after the close today. Really appreciate your time. That is Peter Saleh, BTIG Managing Director. Now, still ahead, we're going to take a look at the companies making the most social buzz today in our Social Climbers segment. Up next, this is Bloomberg.